Millionaire by 33, starting at age 20 with 50,000. What's your thoughts on that?
Well, I think a much easier way is just buy a BTO, wait 10 years, then the BTO double what already.
Okay, welcome back to another episode of the Backholder Pod. Today, we are going to talk about something interesting. CNA Insider just dropped a new video. A Gen Z investor strategy to become a millionaire by age 33. Money Mine. So I think Money Mine or this investment genre has been a very good source of inspiration for us on our Backholder Pod as well, because we always tend to look at them. They do, or they get very interesting personalities or people to talk about their own investment journey, their thoughts and whatnot onto the CNA platform. And then it's broadcasted to a very large pool of audience. Usually they get like 40, 50, 100K views across cumulatively. So I think let's talk about this specific topic. So let's define a few things first. So in case you guys don't know, Gen Z is born in the time period after 1997 to 2012. Correct me if I'm not wrong. So that's the period. Wait, let me fact check myself. Generation age. Okay, yes, correct. So Gen Z is between 1997 to 2012. Millennials are from 1981 to 1996, and then Gen X is 1965 to 1980. So this interviewee in question today, he's called Eugene. So he's 20 years old. So he's probably born in the year 2004. What a time to be alive. But anyway, so Mr. Eugene here, his 20, and I'm just gonna give a quick summary of what he basically said in the video itself. So he's currently 20. He has actually managed to amass $50,000 at age 20 years old. He has currently in his portfolio, he has 80% allocated to equities, specifically in the Singapore stock market. I believe that's all he has, meaning 80% all in, 15% in cash, and 5% in fixed income. So he attributed this so-called performance due to his very tender age of 14. He was being introduced to the idea of investing and the idea of dividends and whatnot by his parents. And he has a vision, or he has a goal of trying to hit $1 million by age 33. And this is the first part where he was giving out more, I guess, general advice on what he's intending to do and his outlook of investment. On the second part, then there was this short interview with Willie. So I believe he runs I don't know what they call it, community called, and I think he's called the Dividend Titan, where he also focused mainly, I guess, in the Singapore market and talking about dividend investing. So he gave a few tips on how he can potentially quicken the process to hit 1 million by 33. So he said that to diversify and to look at US stocks, to contribute more money to the portfolio as income comes in, because if not, he would need 25% CAGR, compounded annual growth rate, to grow 50,000 to I guess $1 million in the next 13 years. So to also reduce the pressure to consistently outperform the market and to allow for greater margin of error. So I think that's a very quick summary of this discussion. So we'll just open the discussion to the floor. Maybe to Kelvin first on what's your main takeaway from the video, and Millionaire by 33, starting at age 20 with 50,000. What's your thoughts on that?
I was looking at the ED, the hardware zone, very nice forum. They are saying all these people started appearing when there's bull market, and when the market crash, all these people will disappear, which I think is partially true. Like 2020, there was a bull market, right? All the YouTubers like me started appearing. Then once the crash in 2022 happened, like 90% of them are all gone. So Eugene, my friend, I wish you well. But okay lah, he being able to save like 50K at 22 years old, I think is very impressive.
20, not 22.
20, wow, that's even crazier. Like at 20, I don't even have like 10K in my savings account, and he had 50K in his portfolio already. Probably he was working, definitely working. Then part of it was from Ampang money and stuff like that. I think starting with Singapore stocks, 80%, 100% of his portfolio in Singapore stocks, I think it's very good as a start. But I think I would agree with the Willie, the dividend titan, that he should move over to the US market, but not move all in because everything is overvalued. There's a slightly higher chance of going down. It's better to just DCA instead. Then he wants to 25% CAGR. I don't think not everyone can reach that, other than some I don't want to say the name. Some people. I think like so for to be more sustainable, he needs to dump in more cash rather than asking for more returns lah. So I did the math. So it's about if you want a 10% annualized return, which is I feel is doable if the market doesn't crash. You just need an annual monthly salary of like 4K a month for the next 10 years. Yeah, then you hit your 1 million. No? Then you can go and retire already. So I think that's his plan. Basically, need to change a bit here, like move to US stocks, increase his earnings. Oh, then got him already. 1 million, retire. Can start YouTube channel already.
Okay, Eric.
Well, I think a much easier way is just buy a BTO, wait 10 years, then the BTO double what already.
But got BTO means got girlfriend. Got girlfriend means cannot save money.
The BTO double already mah. You make money on the BTO.
But the money cannot use because it's stuck right in the asset.
Yeah lah, that's true lah. That's
Yeah.
true also. But you have the asset lah. Just that if you sell it, you can get the money.
So your thoughts on Mr. Eugene?
I think he's very impressive. When I was 20, right? Well, where was I? I think I was still in the NS. Like maybe I have 10K in savings, maybe. Yeah, but 50K at 20 years old, I think is very, very impressive. But nowadays, I don't know, like if we adjust for inflation, by the time my son reaches 20, I think maybe he will have that amount also. Yeah. Because the money is getting smaller and smaller, right? And then the value also going down. So I don't know. Chiking, you're probably nearer to his age range. Do you remember how much you have at exactly 20 years old?
Definitely not 50 lah. I think despite maybe I don't my ang pao money not as strong as him, but I did save a majority of my NS income, and I still had the side income the other time that I was talking to you guys about, right? About the idea of like selling duties, right? So that was also a good quick. But I think the range is probably 25, 30. I think it's confirmed less than 50K. Confirmed less than 50K. But it was also because I was buying stocks that didn't move lah back then. I think I was in a commodity stock, which is Keppel. So that one only give dividends, but it didn't like multi-back. So I do know of like maybe a few friends in Singapore, SGX, right? If they did put money or back companies that can multi-back, then that improvement is very significantly faster lah. Yeah.
I don't know whether you guys notice why the caption is 33 years old, right? I think that to hit the 1 million, he got explained. He said 1 million by 33 is because he want to be like Warren Buffett, because Warren Buffett also hit his first million around age of 33 or 32 or something like that. So he want to have the same, he want to hit the milestones that's similar to Warren Buffett. Two things our cautions. First thing is that Warren Buffett 1 million, I think is US dollar. His one, I think, is Sing dollar. So got a bit of difference there. And then the other things to mention is that I think Warren Buffett hit that level when he was, I think that was 1960s. So, and then the target that he wanted to hit, right, which is 13 years from now, right, that should be 2037. So that's like 75 years apart. So just to give you a difference, 75 years apart, if the inflation is about like 4%, right, within these 75 years, right, you are talking about like, the difference, the magnitude is 1 to close to 20. So it's equivalently Buffett's 1 million in today's dollar, it should be about 20 million. So there's a big difference just because of 75 years apart. Just do some maths there.
So what's the greater takeaway?
Greater takeaway is that actually 1 million, the bar is too low. You want to hit Warren Buffett level, don't hit 100%, just hit 50% okay already. Then also you need 10 million. So yeah, target higher. Maybe don't start from investing, start from doing some, like startup, go and create some, super AI technology companies, sell it to Google, and then straight away pocket the 10 million, 20 million. So I think this is a lot more doable compared to, compounding.
Actually, that's sort of true. Like okay, not create an AI company, but you got 10 years. Okay, basically because you are staying with your parents, you don't have a family yet. Your bases are all covered. Or in other words, you are basically financially independent. More like dependent, FD, not FI. Financially dependent. But because you don't have any responsibility to care, all your money you can actually go all into investments, or that's why you can afford to make mistakes in these 10 years. So I will also say try to aim a bit higher. Not like, okay, I want to buy Singapore stocks, get those dividends, yay. Then because when you get those dividends, you're going to either reinvest it, then you'll be paying commission, or you'll be spending it, which will take away your compounding. So my first takeaway is avoid dividend stocks, especially when you are young, because it has no net benefit to you. You say, oh yeah, but I receive money leh. But then money it come from your share price, right? The share price drop. So that's the first thing lah.
Yeah.
Second
Because
one, yeah.
yeah, I'm thinking that because we will say different things because his age. So someone say I want to hit this level in 13 years, but he's 20 years old, right? Versus another person who is, let's say, 35, right? The kind of advice they will give is should be different. For 35, you're expecting the person is already like, okay, you already have your job. If you don't have a good, high-paying job, you should, upgrade your skill, but upgrade within your current profession, your current area. You want to build onto whatever that you already have, right? You don't want to be at 35 years old, suddenly want to change job and then change profession, change industry. That will be a lot tougher. But I would say that for someone who is 20 years old, right, I think the biggest advantage that they have, right, is that they are native to what we call this AI world. For example, like myself, right, I also use AI too, but AI will never be native to me because I can say that I'm native to internet because the moment I start learning about like computer, right, internet is there already. Internet has been around for don't know how many years already. So it's native to me. But AI, right, I think it's not native to you, me, four of us here. We are not native because the moment we know about things is like we are playing catching up. It doesn't sounds natural to us. But I think for the younger folks, right, let's say like 20 or below, right, imagine that now they are still in their learning curve. Everything still fresh to them, like they're still learning. And AI, the directions, the capability is all there already. I think they should make full use of that. Definitely, they are way better than those who are 30 years old, for example, just because of their age. So I think they need to play onto their strength rather than play the old man game. The dividend dividend investing, this is really for those probably those who are, like, let's say, 40 years and above. Like people like Eric, don't need to play all these AI things. You have like few million sitting in the dividend stocks, and then every year just collecting, high 6 digit, 7 digit. Okay, yeah, the youngster, you're going to play. I don't have to play all these things. These are, you play different game depending on your age.
Eric,
Eric,
you got cute
yeah.
So you got any comments?
So I would say I started buying REITs and all that when I was like in my 30s. Not really that old yet. But I still like the idea of like getting regular payouts. Yeah, I don't know. It just felt.
No, Eric, will you say the same if your account now, your dividend stocks is only, let's say, 100K, 200K, so tiny?
Would I say the same thing?
Yeah,
No lah, it's the same lah. Just whatever amount that comes in.
receive dividend checks, $200. Pui.
No.
It's
I
very
still
different. You receive a 200 dividends checks versus, like 15,000.
You'll be surprised that I used to have a share. I think I still have it. When I bought the share when I was a stockbroker, like some sort of ETF, Nikko Singapore Index ETF, and I bought 100 shares of that, 100 units. Then every quarter, right, you give me like $1 plus. I get the dividend. I always get the notification, but I also feel happy.
Actually, chicken also can work. He's every month he sell $100 Alibaba. He say, oh yeah, I got passive income $100 this month from Alibaba.
This Kelvin don't want to
They
let
go
go of
reinvest the
the
money back. Say, wow, compounding effect.
Alibaba pays a dividend, by the way, in case you didn't know.
Yeah lah.
Don't
So
need
you
to
add
sell.
another $100 into it lah. So you increase the dividend yield.
Yeah, lor. In a way, yes lah. That's why I don't sell lah.
this Kelvin don't want to let go of the dividend irrelevance theory. Keep on bringing back.
Okay lah, the dividend, I think there is I guess from the previous episode, right, where we know that if that's a Singapore macro strategy to constantly appreciate the Singapore dollar, there is a role for dividend paying companies or investing in SGX lah. Especially so when we saw the US dollar recently has dipped quite a bit, right? I think it was like 5 to 8%. Even all your gains will be wiped out by foreign exchange ma. And not to forget, when you convert in broker still take a FX, and then the FX fall, and then if you convert out again, you take another FX hit. So in a way, all these are compounding in nature. So I will understand that if somebody needs to draw out occasionally, then there will be a hit to. There'll be a lot of all these unseen risks that you also need to take into consideration. Does not mean that you just all in S&P 500, Nasdaq, confirm win, because the idea is always at least the theory or the supporting argument is at least 20 years. But what if I don't have 20 years or I need in between, I suddenly need to take money out? So investing in Singapore market still have its merits, but I think specifically for this guy at 20, if he's setting his goal at 33, um, unless he's really very good at picking like Kim Lee or whatever individual stocks that can multi-bag, I don't know what's the moving forward in the next 10 years, what will be multi-bags. If not, if he's adopting a more of like an index approach, then yeah, I think SGX might not be the best vehicle, even though they broke all-time highs recently. Yeah. So that's my perspective lah. But I think like the calculations that Kelvin did, right, about even earning just a normal 4,000 median income and don't have any expected appreciation in salary for the next 13 years, he can also hit his goal. I also did my calculations. I agree with Kelvin's conclusion, but I think the biggest worry, especially for younger folks, is deadly mistakes lah. So let's say going to margin, going to leverage, not saving enough of your income, or like getting distracted along the way. I think people tend to forget these two things, which is consistency and luck. I think these two things are always very important, because consistency, both in terms of CAGR, which is your returns profile, it might not be 25%, but even if you can consistently achieve 5 to 8% for the next 13 years, but if you consistently put in money, you still hit that goal. Secondly, which is luck, the luck component. Who knows? Maybe at 32, everything is building up 800,000. Then suddenly next year, boom, 50,000 down. You also LL, right? You can't do anything because the market just don't go in your favor. So I think don't be too fixated or harped onto that specific like goal by this age, this number, or this kind of thing. I'm quite sure when Buffett was compounding, he didn't, I must 1 million by this X amount of date, or this X age. Or even at today, when he's managing like hundreds of billions of dollars, he don't say down to hit this amount. So it's just that he's really enjoying the game. He's improving his skill set, his expertise and whatnot. Don't fixate too much on that particular number lah, and just try to get better and stuff.
I think for Buffett, right, you also need to remember how he hit his first million, right? It's not really through compounding. Although Buffett really started investing, even started doing business in very like young age. I think it's like, don't know what, 13 years old. So, but actually, I think bulk of that first million, right, actually came from his active income, and specifically his active income is really managing people money. So what he did is that he collect, like, okay, he managed other people money, right? He don't collect the annual fee, but he said above certain threshold, I will take like 1/4 of all your gains. So for example, I forgot the exact details. It could be like, above, let's say 6% or above 10%. Everything above that 10%, right, I will take 25% of the gain. So, and he had a right in the early years of his investing, so he really profited a lot. It's the second half, maybe, I don't know the exact years, then he converted the partnership, everything into like put the money back, put the money to buy Berkshire Hathaway. Then only the later years compounding started. But the initial years, I will attribute that to his active income. So focus on the active incomes, especially for the younger crowds.
Yes, I totally agree with Bunti. I think it's very important to build up your earning power rather than to be so fixated on the investing thing. Yeah. So I used to be very fixated because I was a school teacher before, and then my pay is fixed. There's a fixed pay structure. So I didn't have to think like how to improve my earning power. So that's why I turned to looking at investment. But if let's say you're able to improve your earning power, right, whether is it side hustle or whatnot, improve that earning power, then yeah, I did a search just now, right, on the Google, and I say that how much would school teachers have in their CPF if they teach for 30 years? So the answer was like, you will have anywhere from 500 to 800K in their retirement account. So that's quite a substantial amount of money, right? Even without any investment at all. So if you're a school teacher, you don't invest at all, right? You just like let the CPF do its thing. By the time you're 55, you will get quite a sizable amount in your retirement account. So don't even need to invest.
He wants to retire at 30, not 55.
No, not specifically for him, but I'm saying that for general people, even if you don't invest, you just do your own thing, you just earn as per normal. It's automatically saved for you already, like a good sum of money. Yeah, so don't have to worry about that. So I think that's why we are quite fortunate here, right? It's all planned out for us, even if you don't plan for yourself, which is not advisable actually. I suggest we plan for ourselves so that, our own investments and savings would actually be enough for ourselves, for our wants. Yeah. So that's my thoughts.
I think if I can push back a little on what Bunty and Eric said, right? I think it's because of the crowd and the audience that we are talking to. Specifically, I think when I interact with people from different, I wouldn't call it classes lah, but maybe different SES, right? You'll see that it's interesting because our channel is focused more on investments. So the crowd that we are talking to, they usually consume this kind of investment related content. And then Bunty and Eric's advice would on the side of don't focus too much on your investment returns, try to focus on your income. But then on the flip side, when you talk to people with very high income, they tend to also not really be bothered about investing because they think that their income is very high. So I think we probably might want to take a more balanced approach where on one hand, you also need to make sure that your income is strong and then you save more than you earn, or at least try to spend less than you earn. And on the flip side, you also need to also consider that you need to put this money to work rather than every day put in I don't know your fixed deposit. Previously, before even this, when you talk to people, some of them that are very very risk averse, right? They'll put into a 1-2% fixed deposit before this whole interest rate hike thing. So in a way, you need to juggle both and to also understand that you need to take a more balanced approach rather than focusing too much on one end. And you can see people, I do have friends like in the whole agency, or they really earn very strong income, but then the money that go missing one at the end of the month. Like I don't know, after earning so much money, the money still, they keep saying they're very poor, or they don't invest, don't have time, don't have the capacity or whatnot, and then they need the business cash flow lah. So in a way, I think we need to look at it in a more holistic approach. And I guess in specifically for our crowd, the advice would be to push your earning power because you're already very interested in investing and you should let the investing thing take care of itself. But I think if it goes out to a more general public thing, we need to advocate for like both sides of the thing as well. And not say just focus on increasing income. Next time, then you'll know about investing. Because this one I don't believe. In a way where if you don't start early or if you don't approach it when you're younger, right? I do understand of like those in the 30s, 40s that they start investing, right? And then they have big capital already. Then they start to do stupid things. And then that will hurt them even more because they don't have a earlier understanding or appreciation of what this whole Kager, why do you need to invest? What's the logic of a stock market and stuff like that lah. So that's just my own understanding based on my own context lah. So yeah.
Just to add on what Chiking is saying, right? I fully agree, 100%. But I also think that investing, right, is a swing your bet very infrequently kind of game. It's like what Buffett said, right? Just think like in 1 year, right, you're probably going to buy or sell or whatever decision, right, just 3 times. Limit yourself to just 3 swings of the bet. Then you only swing at very good opportunities. Yeah, so a lot of times you're just learning about investing, right? You're not actually doing anything. But a lot of people make the mistake of activity of investing, buying and selling, without doing their due diligence. So that's why I would say that a lot of people don't learn from their mistakes. I hope we do, because we always bring up the past episode to critique ourselves. Yeah, but most people don't, and we don't have anyone to call us out. It's not a problem for us because we always call each other out. Yeah, but most people in the general retail investing space, right, they don't have anyone that knows what they are doing. Like their spouse might not even know what they are buying or selling. So nobody will call them out. Nobody will be their sounding board. And then you make the same mistakes like of your whole life. Buying high and selling low. Those kind of very novice mistakes. But I think, yeah, we all need people to kind of be sounding board for us. Yeah, so I don't know where, but I think investing and also increasing your earn income both at the same time.
Learn from Kelvin. Just be a YouTube, post your stuff, and then there's a lot of sounding board at the comment sections. People will whack you.
You post stuff, got people whack you, I think still a good thing. I mean, at least you're gaining traction lah. But yeah, I think in a way, any concluding thoughts from Kelvin?
Concluding thoughts, just do what you're doing. 50K at 20 years old is impressive. I think you easily pass 1 million by 33 if he doesn't do anything wrong. Yeah, so just keep doing what you're doing.
And with that, we'll see you guys in the next episode. Goodbye.